all you need to know about call option. In our previous videos, we briefly touched upon what option trading is. Let us dive in further. Option buyer and a seller. For every option contract, there is a buyer and a seller. Option seller is also called the option writer. In an option agreement, buyer always has a right to decide whether he wants to execute the contract or not, while seller has an obligation. The premium amount is paid by the option buyer to the option seller or writer. Option premium. In options trading, premium plays a crucial part. Premium amount is based on the price fluctuations of underlying asset and many other factors. Some of these factors are open interest, implied volatility, and other factors called option Greeks. We shall learn about them in subsequent videos. While trading in option, there is no actual delivery of shares at the end of expiry period. The trades are done on the fluctuations of option premium amount. And there are three things that are really important to know when you search for the current price of an option: strike price, expiry date, type of option, call options, or put option. An option chain can be viewed on trading platforms with these parameters. First, let's understand call option. In theoretical terms, buying a call option gives the investor a right but not an obligation to purchase an asset on a future date at a predetermined price. Let us understand call option in practical application with an example. Let's say you hold a bullish view on stock XYZ Limited. At the start of October month, stock is trading at 195 rupees. You expect the price to rise to 220 rupees by the month end. The call option premium of XYZ Limited at the strike price of rupees 220 for expiry date of 28th October is currently at 4 rupees. It will be denoted on trading platform as XYZ Limited 28th October 21 CE 220 at rupees 4. When price of XYZ Limited moves from 195 rupees to 210 rupees, the option premium will also move up. Suppose the premium goes up to 8 rupees. You can book your profit and sell the option or wait for it to move up further. Similarly, if the stock price moves down to 185 rupees, the option premium will drop too, resulting in the buyer of option to suffer loss. Call option selling. Regardless of your long-term view on an underlying asset, if you think the value of underlying asset would not reach a particular strike price, you can opt to sell a call option. In our example, the stock price in current market is 195 rupees. If you think the stock price will not reach the strike price of 220 rupees, you can sell the call option for strike price of 220 rupees. As a seller of the option, you would receive the premium money, and your position will be squared off on the day of expiry. If you liked our video, like, share and subscribe to our channel. And for more such videos, visit our website www.edelweiss.in.